After 9 months of waiting, the US Federal Reserve has finally lowered interest rates in the US and flagged that it's very likely there'll be 2 further reductions in US interest rates before the end of the year. And I say finally because it seems like we've been talking about these potential rate cuts for a very long time. And the proof of that is that nothing happened. US markets basically yawned. 10-year bond yields rose slightly, which had more to do with the 20-year note auction than anything that the Federal Reserve said. And the share markets were flat. Once again, we saw divergence in performance between the Dow, the S&P 500 and NASDAQ, but they're all within 1% of square for the session. And there was really very little market reaction because this move has been so well flagged. So no surprises. It's been delivered. It's been confirmed. We'll likely see further reductions with the US Federal Reserve Chairman, Jerome Powell, indicating in his talk after the interest rate decision announcement that the shift in the focus for the Fed is towards unemployment. And he pointed to the uptick in unemployment as the key reason why the Fed has gone ahead and confirmed its dovish stance over the US economy. So very much in line with market expectations. There was a slight change in that next year, the dot plot, that is the estimates provided by the governors themselves, suggests there'll only be one further reduction in rates next year. That is less than the market is expecting, but that didn't seem to factor into the market reaction in overnight trading. Nonetheless, it does appear that the Federal Reserve is trying to indicate that the floor for US interest rates is not zero, at least outside global emergency conditions like the COVID pandemic. So that might be part of the thinking that the floor for US rates is closer to 2% than 0%, and it might be part of the Fed's messaging over the coming months that that is the case. Something to look out for. It could cause a repricing in other markets. The other news that would really seem to affect trading yesterday was media reports, and I stress they're only media reports, they have not been confirmed officially, that the Chinese Internet Agency has instructed Chinese companies to cancel any purchases of NVIDIA or any orders that it has in, and not to purchase any further chips from NVIDIA. And the impact that we saw across markets was very significant. Semiconductor stocks very much in focus in every centre in trading over the last 24 hours. Now we have seen a lot of support for Hong Kong tech stocks. The tech stock index in Hong Kong was up more than 4% yesterday. The Hang Seng itself was up almost 2%, and it is a continuation of a theme that we've been talking about since the end of last year, and that is the relative undervaluation of Hong Kong stocks generally, and in particular, the global search for growth exposures outside the US, with US shares at eye-wateringly high valuations. International investors are looking for other high growth opportunities around the world, and the big lift that we've seen, particularly in Hong Kong tech stocks, suggests that Hong Kong is one destination for those international investors. The tech index itself is up 80% this year, and the momentum in both the Hang Seng and in particular in Hong Kong tech stocks looks very positive and clearly pointing upward at the moment. Now, things of course can change at any time, but at this stage, that very clear momentum is really playing out in individual stocks as well. Yesterday, Bidu was up 16%. Alibaba and JD.com, two retail and cloud giants, up 5% in trading yesterday. The Semiconductor index was up 5.5%. The confidence in the Chinese artificial intelligence story seems to be growing. So investors following their instincts and going into those China-exposed higher growth tech stocks. One of the top performers yesterday, SMIC. Now, just to be clear, this is not SMCI, but SMIC, listed on the Hong Kong Exchange. A Chinese semiconductor stock was up 7% yesterday. Now, its market cap is more than 500 billion Hong Kong dollars. It's up more than 100% so far this year, and many analysts retained strong buy recommendations on SMIC. So they're testing their first advanced artificial intelligence chip-making tools, and there seems that at least the lift in the share price is indicating some investors have real confidence that this technology will be delivered. Another one in the news at the moment is Wolfspeed, a US listing. Now, Wolfspeed is a much reduced company. It has It makes components for electric vehicles, think chips and integrated circuits, and it's had some real troubles, particularly around debt. Its share price has been absolutely decimated, falling from above $140 a share in 2022 to currently be trading around $2.70. So there's been a huge reduction in its share price. And the restructure of its debt that's just been announced might give it a reprieve. And certainly share price action does indicate that it's moved off the bottom, that the huge downtrend in its shares may have come to an end, because the lift we saw was very solid. Now, the restructuring is important because 80% of this debt is held by an affiliated company, and that company is not looking to put Wolfspeed into liquidation. It was the remaining 20% of the debt that was threatening the viability of the company. And with that restructured, there's room now for Wolfspeed to recover its capital generation abilities. Now, I've got to be very clear about this. This is a high-risk endeavour at the moment. The operating cash flow doesn't even cover the interest bill. So it's going to require further support if it's going to get back to capital generating capability. But nonetheless, a lot of investors running the ruler over Wolfspeed despite its distressed situation because of that very low share price and the potential for a very significant recovery if it can get through the current difficulties. Speaking of difficulties, this morning Santos has announced that the bidder ADNOC, the Abu Dhabi corporation, has walked away from its all-cash bid, the $36 billion bid for Santos. This is, of course, bad news for Santos shareholders. The share price was below $7 before the announcement of this bid. It traded up to a high towards $8, still below the bid price after the announcement of the bid. But the concerns about Foreign Investment Review Board restrictions around this deal has meant that it never traded near the share price indicated as the bid price at $8.65. With this bid now falling over, there's a real concern for Santos. Could very well trade below $7 this morning. It's under pressure, and that's no surprise. So the pressure that we're likely to see on Santos is ongoing. The worst part about this is that this is the third bid for Santos that the board have failed to bring to fruition. And looking back across the last 7 years in those three bids, Santos have been bid for by private equity, by a national oil fund, and by a strategic partner, and have not been able to get any one of those deals over the line. It's quite possible there will be changes at the highest levels in Santos following this announcement.